Welcome to the Daily Drawdown, where today's brief runs from baby brokerage accounts to AI power bottlenecks. The practical story today is scarcity, scarce power for AI, scarce near-term chip supply, scarce float in a newly indexed mega name, and scarce room for rates to fall if fiscal spending stays hot. Washington's proposed Trump accounts would seed eligible newborns from the cited 2025 to 2028 birth cohorts with $1,000 in a tax-advantaged investment account, with the stated goal of broadening stock ownership early. BNY Mellon is handling core infrastructure. Robinhood is positioning as a subcontractor. And one cited data point says about 86% of contributions so far come from families earning under $200,000. Why it matters is the mechanics. Cash contributions reportedly have to sweep into an S&P 500 fund, but donated individual shares can stay in kind, which creates a clean path for direct stock gifts into these accounts. That is why the eye-catching philanthropy matters. Gwen Shotwell was cited donating 2 million SpaceX shares to 2 million children, with long-holding restrictions, and Michael Dell's multi-billion-dollar pledge was used to show how voluntary capital could scale this faster than public funding alone. What to watch next is adoption, employer matching, and whether political branding changes behavior around what families choose to contribute or hold. The biggest market constraint in AI still isn't models. It's power, land, and long-dated access to high-quality data center capacity. Demand is coming from hyperscalers, private labs like OpenAI and Anthropic, and enterprises, and the key point is that private demand can keep running even if some public cloud budgets stop rising in a straight line. The clearest proof point was TeraWulf's long-term deal with Anthropic, described as a 20-year arrangement and around 400 megawatts in one account. That is a real commitment in a market where suitable sites are limited and can't be built overnight. It also reinforces a second theme. Old crypto mining infrastructure is being repurposed for AI compute. The market took that seriously, and TeraWulf shares moved higher on the news. What to watch is lease duration, power pricing, and whether third-party capacity providers keep winning business from private labs and even from big platforms looking to outsource part of the load. There is rising skepticism that hyperscaler AI capex can climb forever without pause. Analysts are flagging reallocation over endless expansion. Microsoft's roughly 4,800 job cuts concentrated in Xbox fit that pattern. The message is straightforward. Less spending on lower priority businesses, more capital and talent pushed into Azure, AI, and data center returns. For the market, that matters because a moderation in one pocket of hyperscaler spend does not automatically mean falling AI demand. Private labs, enterprise backlog, meta-leasing third-party capacity, and deals like Anthropic TeraWulf can buffer the system. Semiconductors have bounced, but the rebound still needs validation from earnings. Samsung, SK Hynix, ASML, and TSMC are the checkpoints that matter. The bullish case is familiar and still live. NVIDIA Blackwell demand, DRAM tightness, Broadcom's Apple ASIC win, and the view that memory pricing stays firm because demand is still outpacing supply for more than a year. Broadcom's reported multi-year custom ASIC extension with Apple through 2031 is especially important because it shows major consumer OEMs are embedding more AI compute on device, not relying only on the cloud. On memory, rising DRAM prices support revenue expectations. Though this market has more flexible supply than leading-edge logic, capacity can be ramped faster, and OEMs, including Apple, were reportedly sourcing Chinese memory to plug near-term gaps. The risk side is just as important. Some desks still see this as a short-term reset, not a durable regime change, with systematic deleveraging, thin summer liquidity, and possible hyperscaler capex moderation keeping volatility high. SpaceX joining the NASDAQ 100 is a mechanical demand event first and a story stock second. Index funds are expected to buy roughly $4.3 billion of shares in the near term, even with an initial weight under 1%. But the setup looks unstable. Reports cite very high implied volatility in the mid-90s, an extremely tight free float around 3% in some accounts, heavy call activity, and a much larger supply wave later if lockups and secondaries release stock. So the practical takeaway is simple. Forced buying can support the price short-term, but tiny float plus options, enthusiasm plus future supply can produce very sharp swings both ways. The commercial fight inside AI is shifting from capability headlines to pricing power. Critics, including Palantir's Alex Karp, argue per-token pricing can feel extractive and may push enterprises toward cheaper or open alternatives. The counter is that usage is still growing fast. Providers are posting record revenue growth, and token consumption indexes have reportedly fallen from peak levels as efficiency improves. In other words, buyers will still pay if the output is worth it. Zooming out, the macro claims are getting bigger, with forecasts ranging from $100 billion of AI revenue by year-end to AI adding over 100 basis points to US GDP growth. That is the bullish case. The pushback is bubble risk. Massive capital deployment without durable moats can still end in painful repricing, even if the technology trend is real. Layered on top is national security. Frontier AI and compute are increasingly treated as strategic infrastructure. China is promoting domestic open-source alternatives, and cross-border procurement is getting harder because privacy and surveillance concerns now directly affect buying decisions. Macro still matters because higher-for-longer rates can overwhelm good micro-stories. A possible September fiscal package in the $300 billion to $400 billion range would complicate the Fed's path and could keep yields elevated. Some commentary has the 10-year pressing toward 4.5%, with curve compression reinforcing the idea that inflation control remains central. If that holds, equity leadership can keep rotating. In energy, OPEC Plus is increasing output modestly starting in August, which has added slight near-term pressure to crude. The more important variable is demand, especially from China, where weaker import signals and a pause in SPR restocking have fed downside forecasts toward the $60 to $65 Brent range in one scenario. Across equities, momentum and quant flows are still amplifying every move. July momentum weakness, rotation toward value, and deleveraging all argue for staying selective instead of reading every rally as fundamental confirmation. Away from mega-cap tech, banks and financials are getting more constructive calls for the second half. The argument is solid capital markets activity, decent loan growth, healthy credit, and valuations that still look reasonable, especially in some regional and small-cap names. They also offer a cleaner way to participate in AI-driven corporate activity through underwriting, M&A, and financing without having to pick the ultimate model winner. Biotech is another area to watch for a more event-driven reason. With the regulatory backdrop seen as more workable, investors expect more M&A focused on late-stage assets that large pharma can bolt on without building giant sales forces. And one final plumbing story. Tokenized equities and prediction markets keep gaining traction. Record World Cup betting volumes and the shift of discretionary spend from casinos to online markets show that market structure changes can become revenue shifts very quickly. Those are the pressure points that matter right now: power, pricing, supply, and rates. This is the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.